Hi everybody, welcome to this brand new class, and this is the first class. As promised, we will start every concept from very scratch level, from a very basic level, then gradually we'll go upward. We'll improve our understanding. We'll go to advanced level, because one thing you need to understand, guys, that in stock market, taking a particular decision is extremely important, because stock market moves really fast. So you need to be very smart to take a decision, and this decision taking quality will improve if your foundation is extremely strong, solid. Then only you will understand everything in the stock market, and it will help you to take the decisions. So firstly, in this class we'll deal with a particular concept, which is the most important concept in the stock market, which is called as OHLC. OHLC. Now, what is OHLC? This is the OHLC slide. We'll understand with very minute detail, right? Because it's important to understand the details. OHLC, this is firstly, OHLC mean. What is the meaning of the OHLC? O means open, H means high, L means low, and C means close. Open, high, close, and low. Right? This is the open part, this is the high, this is the close, this is the low. Now you know the meaning of OHLC. Now how to interpret this? We need to understand the interpretations, right? Let's say open. First we will understand, we are decoding the meaning of OHLC, right? So O means open, where the candle is opening, that is O. For example, this is the stock market. Let's say, I understand my drawing skill is extremely good, please forgive that, but take this. Okay, firstly, this is the opening. The stock market is opening here, the stock market has opened here, so this is the O. In a particular day time, the stock market has gone up to this particular level. The stock market has gone up to this particular level. So this is the H, high, the highest point the stock market has achieved in a particular day. That is the high. Day or month. This day, month, this dilemma will be clarified in the time frame analysis. So for now, let's see this example as a day on a day, from perspective of a day. So this is the highest point where the stock market has gone up to. See, this is the highest point, right? Again, let's say this was a price of, like, for example, anything $5, and this was a price of $50. So stock market opened here, then it went up to this particular price, 50, which means now bulls are strong. Now bulls are making the pressure to go up, hence the stock market is going up. So this is the highest point. Understood? This is the highest point. Now when the market was in the highest point, the bearish, I mean the bear trader, the bear gang, they made a pressure, and the price, for, let's say, price gone up to this particular price level. This is the $1. This is the $1, right? So this is the lowest point. This is the lowest point. The lowest point the market hit in a particular day, that is the lowest point. Now after that, market closed near about here. Again, the bear first market, this is the close. See, which means the closing price. Now revising one more time for your clarification, for your understanding. Understand it very well, concentrate, focus. The market opened here. This is the opening price. Now the bull made a pressure, market went up to this. This is the highest price, highest point, highest price market achieved in a particular day. That is the H, highest price. Now here selling pressure has started. Now when the selling pressure has started, naturally the market will go down. So market, let's say, went up to this. This is the lowest point, right? And finally market closed here. From lowest point again the bull gang made a pressure. The market closed here. That is the C for closing price, right? So this is the definition of HCOL. Just read it as OHLC for your benefit, for your understanding. It will be easy for you to understand in this way. OHLC. If you want to understand this in HCOL, it will create confusion, right? So make it as OHLC. Now one more thing in this class I want to inform you, which is very, very important. That is, number one is a bullish candle and number two is a bearish candle. Now if we see in live market, next class we'll see in the live market, but in this class just understand this concept that there are two types of candle. One is green candle. This is a green candle. The green candles represents the bullish candle, and the other thing is a red candle, and red candle represents the bearish candle, right? So there are two types of candle: bullish candle, bearish candle. The color of the bullish candle is green and the color of the bearish candle is red. Now just a small thing, in a bullish candle, what is the meaning of the bullish candle? Bullish candle means the opening price is lower than the closing price. Understand it very, very clearly with 100% focus, that the bullish candle, the closing price will be higher than the opening price. In a particular bullish candle, the closing price will be higher than the opening price. Why? The reason is, let's say market has opened in $5. Market has opened in $5 and the market finally closed in at a particular price of $10, right? So market opened in $5 and market closed at $10. $5, hence at a particular day, in a particular day, the market moved $5. Market opened at a $5 price level and it went up to $10 price level, which means the price of the particular stock has increased by $5. $10 is the closing price and the opening price was the $5. Hence, the price has increased in a particular day is $5, which means this is a so here the price has increased, which means the day was bullish, the candle is bullish, hence this is the green color. So in a green color, the closing price always the closing price will be higher than the opening price. And in a bearish candle, you tell me what will be the closing price. You pause this video here and you try to figure it out. What will be the closing price? Will it be higher than the opening price or lower than the opening price? You need to understand. If you decode this, if you understand this concept very well, trust me, this is a reflection that your foundation is going to be strong, because this is a very basic thing. You need to understand this thing. So let me tell this. In a particular bear candle, the closing price will be this. the closing price will be this and the opening price will be this. Hence, the closing price will always be lesser than the opening price. The closing price always will be lesser than the opening price. Why? What is the reason? Because market opened, let's say, at $10 price. Now that in that particular day the bear gang was more powerful than the bull gang. So the market, the price has fallen and it went up to $5. It went up to $5, which means the price has what? Decreased. The price has decreased, which is why this is a bearish candle and the color of the bearish candle will be red. Right? So the color of the bearish candle will be red because the price has decreased, and the color of the bullish candle will be green because the price has increased. Right? So this is the complete concept of OHLC. The most important two things is opening and closing, and there are two types of candle. One is a bullish candle and the second thing is a bearish candle. And in case of bullish candle, the closing price will be higher than the opening price, and in case of a bearish candle, the closing price will be always lesser than the opening price. So this is the concept of OHLC. Next class will start from engulfing candle. Thank you so much. We'll meet you in the next class. Hi everybody, welcome to the second class, and as we have already discussed the concept of OHLC, open, high, low, close. So in this segment, in this class, we'll start with the engulfing candle. So what is the engulfing candle? What is the meaning of engulfing candle and how to interpret this? First we'll study in theoretically, then we'll go to the live market and we'll understand how to interpret a particular engulfing candle, how to see an engulfing candle, what is the meaning of engulfing candle, how to take decisions on the basis of the engulfing candle, right? So first of all, engulfing candle, the meaning of the engulfing candle is how to interpret, and the meaning both are, let's say this was the, one second, this was a particular candle and this is the engulfing candle. This candle is the engulfing candle. After a small candle, if there is a big candle, after a small candle, if there is a big candle and the big candle is eating the whole small candle, let's go to the white screen. This was the small candle, right? And after that, there is a very big candle, and this big candle is able to eat or grasp the entire small candle. If the big candle is able to eat or grasp the entire candle, if it is able to engulf meaning eating, like grasping, like the covering, this candle, this particular big candle is covering the small candle entirely. This particular big candle is covering the small candle entirely. So this is the engulfing candle. This big candle is called as the engulfing candle, right? Why this is the engulfing candle? Because this is engulfing the small candle. This is engulfing the small candle. So this is why this type of big candle is called as engulfing candle. Remember guys, one thing you need to understand here, it has to appear after a short candle, after a small candle. After a small candle, if there is a big candle which is able to engulf the entire small candle, that is a engulfing candle. Now what is the meaning of the engulfing candle? How to interpret this? Let's say there is a very small candle, this red candle. Red candle means what? Bearish candle. Now the next candle is a very big bullish candle. The first candle is the bearish candle. The next candle is the bullish candle, and the bullish candle is very big. This is this phenomena. This is it means that
market will go upward. Market will go upward because the power of the bearish candle is much lesser than the bullish candle, and the bullish candle has the ability to engulf the small candle, to engulf the bearish candle. So if the bullish candle has the ability or has the power to engulf the bearish candle, it means now the bullish has more power compared to the bearish candle. Compared to the small bearish candle, the bullish candle has more power. The bullish candle has more power means the bull has more power, and the bull has more power. What does it mean? It means that market will go upward. Market will go upward. So this is the meaning of the engulfing candle. So this is called as bullish engulfing candle. This is bullish engulfing candle. And what is the bearish engulfing candle? Let's say, one second. What is the bearish engulfing candle? Let's say there is a bullish candle, right? And after a small bullish candle, there is a big bearish candle. And this bearish candle has the ability to engulf the entire bullish candle. If the bearish candle has the ability to engulf the entire bullish candle, what does it mean? It means that bears have more power compared to the bulls. The bears have more power compared to the bulls. So it means that if the bearish power is more in the market, if the bear has more power in the market, then market will go down, right? So a bearish candle, how to interpret the bearish candle? That if after a bullish, small bullish candle, if there is a bearish big engulfing candle, then the market will go downward. And at the same way, after a bearish candle, if there is a big bullish candle, the meaning of this, market will go upward, because in this phenomena the bulls have more power, and in this phenomena the bears have more power, right? Are you understanding the concept? If you are not understanding the concept, please repeat this class one time, second time. You will understand the concept. This is my guarantee. This is from my side. This is the guarantee. You will understand the concept. There is nothing is there. No rocket science is here. It's very simple. Small candle and a big candle, and the differentiation is depending on the colors. If there is a bullish candle, small bullish candle, and a big bearish candle, it means market will go downward. And if there is a bearish candle and after that a big bullish candle, the market will go upward, right? Market will go downward here and market will go upward here. Let's go to the live example, then you will understand it very clearly. Guys, this is my guarantee. You will understand everything. This is my guarantee. I promise you. Don't worry. Let's go to the live example. So this is a very random stock. Let's open a different stock. Let's say HDFC Bank. This is not the software. This is a website we are using, which is called as tradingview.com. So you can use this particular website, no problem. And there is one more option of premium version. Please don't buy premium version initially. You don't need a premium version. First study the concept very well, then try to understand the market, expertise, I want to say that please try to be an expert of a stock market. After becoming a stock market, then you buy a premium. Don't worry. Then no issue. Let's go to 1 day time frame. One second. Yep. So you see here, understand this very well. Okay, is a very good example. This was a very small, this candle, I'm talking about this candle, right? This was a very small bearish candle, and after that a very big bullish candle, right? So after a small bearish candle, if there is a bullish candle, it means that first of all, this very big candle has the ability to eat or to engulf the entire small candle. Not this candle, the second candle also. This two candle is been engulfed by the big bullish candle, right? So hence it means that market will go upward. You see what was the result? A very small pullback and the market was boom. Boom. This is true. Engulfing candle works like this only, right? Please understand, there are a lot of things you need to consider while taking a trade. We are not suggesting this trade, but still it is working. The technical analysis will work like this only. Just there are layers of decisions. You need to satisfy all the layers, then you can take the trade. That's a complete different scenario. But in this example, the engulfing candle is working. It's here, right? So this is the example of a bullish candle. Let's try to figure out a bearish candle. 1 second. Let's go backward. Let's go more backward. Okay. You see, this was a very weak bullish candle, and after that a big bearish candle which is able to engulf the particular bullish candle, right? And what does it mean? If there is a small bullish candle and after that a big bearish candle, it means that market will go downward. You see, small pullback, boom. Market always move according to technical analysis. This is not true. This is not true. Market 90% of the time will move according to technical analysis, but there are certain things, like for example, for your information, quarterly results, if something big happens like Russia-Ukraine war, if something extreme happens, then market will go haphazardly, right? But otherwise, if everything is normal, market is going normal, the days are going normal, right? There is no COVID situation, there is no war situations, everything is normal, then market 90% of the time, this is my guarantee, that market will go according to technical analysis. See, everything can be proved false. The predictions of the quarterly results, everything. But price will never lie to you. The price is the, this is the truest point. This is the truth. The price is the current situation of the company. So if there is a prediction of, okay, the market, this company will go beyond its limit, this company will increase their production, whatever it is, whatever the hypothetical situation is. But there is one thing, price. This is the current situations, and please try to believe the price. Don't other things, don't any news, nothing else, because you have the price. If you are a technical analyst, then price is the most important thing. If you understand the price of the stock market, if you understand the price of a particular stock, then please trust me, you need nothing else. No news, nothing. Okay, so this is the engulfing candle. Slowly we are learning all the concepts. Thank you so much, and we'll meet you in the next class. Hello everyone, so let's start with our next concept, which is bullish hammer and bearish hammer. There are two types of hammer. There is bullish hammer and bearish hammer. You have understood that what is engulfing, bullish engulfing and bearish engulfing, how to interpret this, how to use this, everything is, I hope it's very, very clear. It's not, if it's not clear, please go back and re-watch the class as many times as possible, because the more you see, the more you will listen to these concepts. You will understand this concept more with more clarifications, right? With more clarity. So this is the bullish hammer, and the second thing is the bearish hammer or inverted hammer, whatever you say. Bullish hammer, the meaning of the bullish hammer is basically the hammer, this concept hammer, it shows the reversal. It shows that, let's say, market was in a downtrend. Market was in a downtrend, and if you see a particular bullish hammer, then it means that market can go upward. Let's come to this here. This was the, sorry, this was a bearish market, right? This was a bearish market, and if you see a candle like this, then this is the indication. This is the indication that there is a confusion in the market. It does not give you a decision that okay, you go for the trade. No, it does not give you the decision, but it shows that there is a confusion in the market. Market was in bearish market, the market was bearish, but now there is a confusion. Market can go upward. So after this type of candle, if you see a strong bullish engulfing candle or a strong bullish candle, the color has to be green. After this candle, if you see a bullish candle, a strong bullish candle, remember guys, here bullish candle, the color has to be green, right? If you see that bullish candle, then there is a confirmation that okay, you can go for long, because market will go upward now. So the candle is look like this, and this particular region is called as LPR. It's called as LPR. The meaning of the LPR is lower price rejection. I repeat, lower price rejection. So if the candle is like this is also LPR, but if the candle is like this is also LPR. So this is a very strong hammer compared to this candle. This is a very strong hammer. Why? Because the LPR, lower price rejection, is big here. The lower price rejection is very big here. What is the meaning of lower price rejection? That the price got a rejection from a very lower level. The price wanted to go like this, but it got a rejection from here because of the bull's pressure. Because of the bull's pressure, the price got a rejection from this particular price level. So market went upward. So the LPR, the meaning of the LPR is lower price rejection. The price has got a rejection from a very lower level because of the bull's pressure. Market wanted to go like this, but it did not, because there is a bullish pressure. Market wanted to go like this, it did not, because there is a bull's pressure. Hence market went upward. This phenomenon is called as that price went up to this, but it got rejected from this particular price level. Price went up to this, but it got rejected from particular price level for bull's pressure, for a bullish pressure. Hence it went upward. This is the meaning of LPR, lower price rejection. So the bigger the lower price rejection is, the success rate of the hammer will be higher. Simple as that. The bigger the LPR is, the success rate of the hammer will be higher. Now the second thing is inverted hammer. Inverted hammer is, let's say market was in a uptrend, and if you see a candle like this, and it means that there is a confusion. Market was in a bullish trend, right? But now there is a confusion. There is a confusion that market might go downward. Market might go downward because there is a HPR. This portion is called as HPR, which means the price got a rejection from a higher level. Price wanted to go high, but it got a rejection from a higher level because of bear's pressure. Because of bear's pressure. You understand this? That market wanted to go like this. Market wanted to go like this, but it did not. But it could not because of there was a rejection from a higher price, and because of higher price rejection, market went down. This is the meaning of HPR. The HPR meaning higher price rejection. The price has got rejection from a higher level because of the bear's pressure. Market wanted to go upward, but it could not because of there was a bear's pressure, right? Because there was a bear's pressure, there was a selling pressure, hence market went down. This is the HPR. So if you see after a uptrend, there is a hammer and has a good HPR, then it means that there is a confusion, market might go downward. If you see another bearish candle after that, then this is the confirmation that okay, you can go for the bearish trade, okay, you can go for the down trade, okay, now you can sell, right? So this is the confirmation. Always remember guys, the second candle will give you the confirmation. The first candle will show you the interest and the second candle will give you the confirmations. So this is the bearish hammer and the first thing was bullish hammer. Some people says about the color, but I will suggest you, please guys, you have to see the color. If there is a uptrend and after that if there is a red bearish candle, red hammer, then obviously the success rate will be higher. But focus on the LPR and HPR, the size of the LPR and the HPR, because remember guys, the bigger the LPR and the HPR, the chances of the success rate of that particular hammer candle will be higher, right? So focus on the LPR and the HPR. Let's go to the live market. If you see, market was in a downtrend, right? And there was a very, very strong bullish hammer pattern. There was a very, very strong bullish hammer. And if you see the LPR, you see a long LPR. What I have said you, that the bigger the LPR is, the success rate of the particular candle will be higher, right? So there was a big LPR and after that also a bullish candle. You see the result? You see the result, it's in front of you. You see the result. If I zoom it out, 1 second. The market was boom. That's how technical analysis works actually. You need to understand the candlestick very, very clearly. Then trust me guys, it will be very easy for you to analyze the market, what is happening in the market. Taking a particular trade, that's again, I have already said, that's a layer of decisions you have to satisfy. But here, to analyze the market, to understand the market, what is happening in the market, you will understand. Okay, there is a LPR, no, there is a big LPR. It means that there is a confusion, might go upward, and again if there is a bullish candle, market will go upward. You see, boom. So this is the thing, and let's try to figure it out. A bearish candle. 1 second. Okay, you see, I don't want to show you a very perfect bearish hammer pattern, because textbook always shows you a perfect example, but in market, live market, there is nothing called as perfect. So you have to choose You have to, work in imperfect situations. You have to deal with imperfect candlesticks, models, drawings like that. So imperfection will be there. So there is an imperfect example, not a very textbook example, but still it is working. That's how you will understand that how to interpret a imperfect situation. Let's say this was a bullish, obviously this was a bullish trend, right? And this was, sorry, 1 second, this candle, this candle was the bearish hammer pattern, right? What I've said you, that after a bull run, if there is a bearish hammer pattern, and you see after that bearish hammer pattern consecutively 1 2 3 4 5 6 bearish candle was there. So it means that the market is weak, the market is going to go downward. You have to take the trade, you have to short the market in that particular price level. In that particular price level, you have to short the market, because if there is, first of all, there is a bearish hammer pattern, and after that 1 2 3 4 5 6 bearish candle. So obviously market will go downward. Obviously market will go downward, right? So this is the beauty of the technical analysis. That's how you interpret the technical analysis, right? You see, for a long period, that happened in a particular, 1 second, happened in month of March up to December. Market was in that price level only. That's how the price action is very strong. So your foundation has to be very strong to, to grasp this kind of opportunity. If you understand the price action very well, if you have the knowledge, if you have taken the trade, just imagine how much money you have. So I don't want to go that money portion, that will come obviously if your concepts are very clear. So I hope the concept is very clear to you. You are understanding the concept. If not, if there is any kind of queries, please get back to us. We'll be happy to help you. Thank you so much, and we'll meet you in the next class. Hi everyone, so welcome to a brand new class, and in this class we'll study a pattern. It's called as Doji pattern. This is basically an extension of the hammer. This is nothing very different from the hammer, but still you need to understand this Doji pattern because it's important. There is a difference. That is why we have made this class a different class, because people confuse between the Doji pattern and the hammer pattern. So we thought that it will be better for you to understand in a different class, then we understand the difference. So what we have studied in the Doji pattern, that Doji pattern looks like this, right? So this is the body and this is the wick part. This is the hammer pattern, right? This is the body and this is the wick part. But in case of Doji pattern, the body maybe looks like this, very small. And what happens in the Doji pattern? This is a difference number 1. The difference number 1 is, I'm teaching you in terms of difference. Then it will clear your confusion, right? Doji pattern is basically look like this, right? So what is the difference? Why I'm saying that this is an extension of the hammer pattern. Hammer pattern, the body will be this, but in case of Doji pattern, the body will be very tiny. This is the number 1. Number 2, in case of a hammer pattern, the lower price, there will be either lower price rejections or higher price rejection, right? But what happens in the Doji pattern, both higher price rejection and lower price rejection, both. So higher price rejection will be there and lower price rejection will be also there, right? So first difference is that the body is very tiny. The body is very tiny, and there will be higher price rejection as well as lower price rejections. Both will be there. Number 2. Number 3, I have told you that in case of hammer, after a particular hammer pattern, let's say this was a bullish hammer pattern because LPR, right? And after a bullish hammer pattern, there was a big engulfing candle or big bullish candle, big powerful bullish candle. It means that okay, you can take the trade, market will go upward. But here the confirmation is not that strong compared to the hammer pattern. So these are the 3 examples that not a confirmation. If the second candle is a bullish candle, after a bullish hammer, if the second candle is a bullish candle, but bullish powerful candle, but honestly it happens in the market. I have seen in the market very many times, because I have made the mistake. It does not create a strong decision. It does not give you a particular decision that okay, now we can go upward, okay, now we can take the trade, because the confirmation level, the perfection of the confirmation is not that high compared to the hammer pattern, right? So this is a basic 3 example, that 3 difference. Number 1, this is the hammer pattern. The body is big. The body, there will be a body, but here the body will be very tiny. Number 1. Number 2, there will be both lower price rejection and higher price rejection. There will be both lower price rejection and higher price rejection, right? And number 3, not a great decision maker. Not a great decision maker, right? This is not a confirmation. You need to get a proper confirmation to take the trade, right? But this is not that kind of a proper confirmation. Hence, it basically creates a confusion. If you see a trade a candle like this, where there is a LPR, there is a HPR and there is a LPR, both of them are there, it creates a simply confusion. You mark this word, it creates confusion, nothing else, right? So the point of this class is, if you see a candle like this, please don't confuse in between hammer pattern and the doji pattern. Maybe you will be trapped, because doji pattern, the confirmation will not be that great. So if you have see the hammer and the confirmation, then you take the trade. But if you see the doji, because you know the difference what is between the doji pattern and the hammer pattern, if you see a doji pattern now, please don't take the trade. Wait for another confirmation. You need to have a very, very strong confirmation, then only you can take the trade. For that, you will refer to the advanced class for Morningstar. There are concepts. There are other concepts. So this is basically to tell you that please don't take a trade on the basis of a doji, because ultimately you will lose your money. So don't play with your money, right? So thank you so much guys. We'll be meeting in the next class.